The metal sector is expected to report a weaker set of numbers in Q1 FY14. This is largely due to the decline in realizations and also due to production cut at the non-ferrous facilities. Margins would be further impacted by higher input cost for the steel manufacturers. Talking on steel prices globally continue to decline sharply. Average prices for export steel was down 10% Q on Q, which was largely due to the subdued demand in China and was also supported by lower raw material prices of iron ore during the quarter. For the domestic manufacturers, steel prices would be marginally lower. The companies would be largely unaffected by the decline globally due to the rupee depreciation. Also, if you look at average selling prices for the steel manufacturers, then it would be flat to marginally higher on a Q on Q basis. Last quarter, many companies had given huge discounts to liquidate their inventory, which led to lower realizations. We expect companies like SAIL and JSPL to report a marginal increase in ASPs on a Q on Q basis. For volumes, most of the steel players are expected to report higher volumes on the back of higher production from the new capacities as well as an increase in their output targets for the year. On the non-ferrous front, volumes for most of the non-ferrous companies except Hindustan Zinc would be impacted due to shutdowns taken by the company or implemented by the government. Sterlite's copper smelter largely remained shut during the quarter, leading to a sharp decline in copper volumes for them. Hindalco too had taken a maintenance shutdown for a month, and so that led to lower copper volumes for them. Aluminium volumes too were impacted for Hindalco due to lower bauxite availability and as well as the maintenance shutdown for their smelters. So volumes for the non-ferrous space except Hindustan Zinc would be lower. HZL is expected to continue to report strong volume on the back of higher mined output, which it was able to achieve last quarter too. On the realization side for the non-ferrous, most of the companies are expected to report a sharp decline. Aluminium, copper prices were down YOY to Q on Q by almost 7 to 10%, and that is a steep decline on a YOY basis. However, the 3% depreciation in rupee would lower the impact of lower realizations for the non-ferrous space. On the margin front, the steel manufacturers would report a lower EBITDA per ton. This is because of flat to marginally higher realizations, but compared to the increase in coking coal cost for them, coking coal contracts were higher on a Q on Q basis during the quarter, and the rupee depreciation has further increased the impact of coking coal prices. So EBITDA per ton for them would be lower. Even the if you compare on a Q on Q basis, then EBITDA per ton would be lower as this quarter volumes would be lower than the Q4 volumes last year. So we expect margins to be under pressure for most of the steel companies on a Q on Q basis as well as on a YOY. YOY the realizations are quite down, so again that would lead to lower margins for them. For the non-ferrous space, again lower realizations, lower volumes and constant input cost would lead to lower margins for them. On the bottom line, we expect most of the companies to report YOY to Q on Q decline in the metal space. In the mining space, NMDC is expected to report strong volume numbers on the back of the price cuts it had taken last year. Coal India, though it has missed the guidance, but the volumes are higher on a YOY basis. So for the mining space, Sesagua, we do not expect much contribution coming from the mining space except the pig iron and the coke batteries, which is a small percentage of their overall operations. So for mining, we continue to remain bullish on NMDC. On the topics of the sector, we continue to like NMDC largely because we believe that over the next 1 year the demand for iron ore would be steady, but the supply there would be curbs on supply in Orissa too, so that would keep the domestic market quite tight. On the cash front, the current cash is almost 50% of the current market cap, which would provide support on the downside. Even the dividend yield for the current FY13 dividend is almost 7%, which is quite high and would even match the debt instrument. So we believe that NMDC, the downside is quite limited, and it remains our top buy. On the non-ferrous side, we like Hindustan Zinc. Again, cash is almost 50% of the current market cap. Volumes are expected to increase. Margins are expected to increase due to internal use of mined metal, and valuations are quite cheap. So Hindustan Zinc is again amongst the best bet in the non-ferrous space.